Layer up. It's been kind of a cold winter already so far in a lot of places. Well, what's going on, Manny? What's going on, Debbie? Good to see y'all. I love my regulars. Yeah. Manny, are you in Mexico City right now? Yeah, you guys are probably getting the same front we're getting. Oh, Monterey. That's right. That's right. That's right. How could I forget? Interesting week last week. And today was kind of funky. Today it was just sort of felt choppy. We're going to talk about it here in a few minutes, but I was feeling pretty good last week. The markets were actually giving our stock some love, which is nice. But yeah, I'll wait another minute or two for everybody to hop in here. I don't know if Nikki's. I think I see her in here. I haven't heard her.
What up?
Oh, there she is. This is actually exciting because a couple things. Well, one, congratulations to Nikki for passing her certified financial planner exam.
Woo.
Digital claps all around.
Thank you.
And two, it's just going to be fun to have you back. Now that you've got hours and hours of time back.
I don't even know what to do with myself.
I mean, help us make some money.
I'm getting caught back up. I'm looking forward to hearing what you've got to say for sure. I'm slowly getting myself back to normal.
Yeah. Yeah, no, that's great. Yeah, it'll be great to have you back with more time to focus on investing in stocks and all things planning too. Yeah, guys. So we have an official certified financial planner now in Skill Incubator. So that's cool.
Yeah. If anyone has any questions that you guys want to run by me or talk to me about anything financial related, finances related, personal, business, pretty much anything. I'll go into some more details a little bit later for the community to kind of let you guys know how you can use me as a resource, but for sure, reach out to me.
Awesome. I'm actually going to restart the recording real quick. I should have had that on there, but let me just get it going. Okay. Welcome, guys. It is Monday, November 11th, 2019, and this is our Stock Market Weekly Update. We're not that far from the end of the year now. Only about 34 trading days left in the stock market this year. So, yeah, it's exciting times with the holidays and everything. But the stock market, volatility-wise, we may have passed our peak for the year. We just we're closing out Q3 earnings season. There's still a good number of companies that are reporting earnings over the next couple of weeks, but the bulk of companies, especially the bigger ones in the S&P 500, have already reported. I think about 90 or 92% have now reported, something like that. So, so we're not too far from the end of the year. And, we've had some interesting developments in a lot of different stocks, though, over the past couple of weeks. So I'm going to discuss some of that later. But first and foremost, just wanted to congratulate Nikki again. For anyone who's listening to this recording, we were talking earlier. Nikki just passed her certified financial planner exam last week. So congratulations to her. She's been working on that really hard for the better part of the last, year or so?
Yeah, for the past year.
That's awesome. So
thank you.
Yeah, so we'll talk more. Like Nikki said, she's going to talk more about what that means and how she, can be a resource to the community going forward. As the weeks go by here, she'll have some things to say on that. But it'll be good to have her back, focused on some stock stuff at times as well. So we'll definitely be excited for that. Just to take stock again of kind of where we are now that we're 11 and a half months into the year, the markets were pretty strong again last week. They were up, about 1% here in the US and about 2% in Europe and Asia. And, even more so, our watch list was actually seeing quite a bit of action, and some of my bigger names in the portfolio actually were starting to catch a bid and see some nice positive movements. So, you probably saw Baidu had a nice pop after earnings last week, and it was good to see them get about a 10 or 12% pop after earnings. So moving in the right direction. Hopefully, I thought the results looked pretty good. I didn't think they were, significantly, amazingly better than the prior quarter, but I think sometimes all it takes is just a little bit of a sentiment change and things not being as bleak as maybe the bears thought, or things like that. So, obviously positive headlines with the U.S.-China trade war talks also probably help some of the Chinese stocks here. So that certainly helps. And IQE, which Baidu owns, as you all know, it's the Netflix of China. They're still growing their subscribers at over 30% year over year. So that was kind of a bright spot. And I believe IQE had a nice pop as well. There, yes, it did. So actually, both stocks were seeing a nice movement there towards the end of last week. As you probably seen as well, CTT, Correios de Portugal, and that one has just been on a tear over the past couple of weeks. Up about 40 or 50% just in about a month and a half's time. Now it's probably due for a cool off, but this is a very undervalued company with a lot of interesting things going on behind the scenes with the activists and the new CEO. So yeah, it's definitely one that we're enjoying some gains on, but still, I think a long way to go. When we zoom out on a longer time horizon, you can see too, where this stock has been in years past. It used to be a double-digit stock, and we were really hopefully buying here at the capitulation bottom. And it's funny to see too something like this where you can see that the stock was just in a brutal downtrend for months and months, right? Throughout all of 2019, this thing just kept going lower and lower, and then all of a sudden, it's so undervalued. And people weren't really paying attention, but you can see how quickly a really, really deeply undervalued stock, especially one that's so beaten up, can recover, right? We just in a month and a half, basically it recovered all of the year's losses within a month and a half. So that's what you'll sometimes see with these really, really undervalued stocks. And some of the stocks that I tend to find will often look like this, right? People will ask me, chartists will say like, "Why are you buying that stock? It looks like shit. The chart looks like shit." And I don't buy stocks just because they're down, and I don't buy, just ugly charts. But what I do try to find are stocks that are so beaten up that people are missing some positive turn in the fundamentals, right? So that's kind of what I go for. But yeah, in this case, you can see that snapback can be pretty quick sometimes, and maybe we'll have the same thing here with Baidu. I think ECA also had, now this one's still a long way. I think it has a long way to go as well, but a really nice move over the past week or two. Oil and gas names, energy names started to get a little bit of momentum back, for about a week or two, maybe. We'll see if it lasts. But that sector caught a little bit of a bid. And so Encana went from, I had given that trade alert, I think a week and a half or so ago when it dipped under 4. And I thought the results were really good. Quarterly results were good, and it didn't warrant a further sell off. And sure enough, we went from 390, 395 up to about 480, pretty quick in a couple of trading sessions. So that was a 20-25% gainer from where we were buying. But, whether it holds that, I don't know. I'm definitely holding this one longer term. I think it can easily be a $6, $8, $10 stock. So, that's kind of what I'm going to wait for, but, I'm not selling any of my position just yet. So we'll see how that plays out. Devon Energy, another one in that sector on our watch list that I own some, and had a trade alert on that one below $20 a share. Just that little dip that it had that day where it dipped below 20. Also really good quarterly results last week. And, the company continues buying back shares aggressively. They're cash flow positive. They've been paying down debt, doing all the right things. Low cost position in terms of, cost position as a oil and gas producer. So a lot of positive things happening there. I think the stock's still pretty undervalued. And this is one that, it can be pretty choppy, but I think can be at $30 a share in a hurry. So we'll continue to keep an eye on that. And I continue to like it here. I think it's undervalued. So That's Devin. Had quite a few other stocks reporting last week from our watch list. TripAdvisor is one that you all saw me probably talk about some. It had a 20% drop after its earnings release. I talked about last week, my concern was with the company's hotel segment, which has been under pressure over the last couple of quarters. And, this quarter that they reported last week and the Q3 quarter was no exception to that. Let's just go ahead and pull up the release, but the problem continues to be Google. TripAdvisor had built a really fantastic business where, they spent a lot of time on search engine optimization. They used to be the first or second link that you would see on Google's site when people searched for, best hotels in Paris or, what to do in San Francisco, right? Or anything that you might be searching related to travel. TripAdvisor was a go-to site and they would pop up, pretty high on the search engine results. And Google has just continued to push them down the page and try to, essentially Google's been, using their own travel booking stuff and placing it on their page. I'll show you guys a video here that I took on my mobile phone last week. If I can pull it up here. This was a screen recording where I was scrolling through. Let me bring this back all the way. So I was just doing kind of a example search here, San Francisco hotel. And you can see, watch as this goes pretty fast, but you'll see that the first few things, and this is on mobile, but you'll see the first few are paid ads. And then beyond that, you'll see, and I'll pause it when we get there. And then the next thing that you see after 4 ads is Google's hotel booking engine right here. That is owned by Google. So all these, if you click on any of these links, go to Google. And now TripAdvisor is the first actual organic link. So TripAdvisor owns a pretty enviable position, right? Being the first organic result. The problem is that Google keeps pushing organic results further and further down. And so in terms of getting users at the top of the funnel who are searching for things, TripAdvisor's traffic and ability to get those hotel bookings is getting worse and worse as Google pushes them further down and de-emphasizes them. So that's really been the problem with TripAdvisor's hotel business, which is still the core of revenue and EBITDA. And we can see here, I'll show you the performance of, and interestingly enough, I do think TripAdvisor is really under monetized relative to the value that it provides. Gets hundreds of millions of visits per year, definitely a name brand in travel, but the problem is that they haven't been able to monetize it as well as they probably should. But experiences and dining is the bright spot. And that's one I talked about last week as well. I said that, that's really a growing business for them. And you see here, it's about 28% of revenue. The problem is that the legacy hotel and, travel booking, part of TripAdvisor's site is still about 3/4 of revenue. Now they did show pretty good margins. You can see that they've actually been cutting costs so that even, the percentage margin, EBITDA margin or profit margins as a percentage of revenue have been getting better in the business. The problem is the business as a whole is still shrinking because absolute revenue is shrinking. Let me see if I can find a good slide that shows that. I mean, even if you just look at the numbers here, Q3 2019, you can see that the hotel media and platform revenue was $238 million versus $270 million last year in the same quarter. So negative, 12% decline in revenue in that segment. You can see experiences in dining grew 19% year over year. It was growing 35% last year. So that segment is growing. It's a bright spot, but the hotels and media business is declining. So you can see that because of that huge revenue decline, even though the margin percentage of EBITDA was higher year over year, the absolute dollar EBITDA was $93 million versus $97 million last year. So the margin increase and the cost cuts are helping the business from shrinking too much, but again, it's not enough to keep it from shrinking. So that continues to be a headwind. I do think potentially with TripAdvisor, there is a price where I get interested enough. It's pretty cheap today. Like for instance, if we look at the enterprise value, they have net cash on the balance sheet, which is always nice, right? They have about, I think, 800 or 900 million in net cash on the balance sheet. So you see it has a market cap of about 4.4 billion today, about $3.6 billion enterprise value. And so if you look at the cash flow that the company generates, I think they generate about 300 million right now of free cash flow. So in the last 12 months, this doesn't have the most recent quarter, but they were last 12 months prior to this quarter, they were generating about 400 million of cash flow from operations. Subtract probably about 60 million of ongoing capital expenditures, maybe a little more. So you're looking at well north of 300 million of free cash flow, maybe even closer to 350 million of free cash flow. Now that number is probably dropping a little bit with the shrinkage in the hotel business, but even if you assume they could maintain 300 plus million of free cash flow, you're talking about an enterprise value of about 12 times. $3.6 billion enterprise value divided by the 300 million of free cash flow. You're talking about 12 times free cash flow, which is a really low multiple. So that's why, I think TripAdvisor is relatively cheap today. The problem is I don't know what kind of a multiple the market is going to give on this thing, considering it is shrinking a little bit and it's facing these headwinds. So I would probably be a buyer of this at like 7 or 8 times free cash flow. I think that would be a pretty pessimistic valuation. I don't know if it's going to get that low. But if it was down another 20% or so, I might consider start buying there at like 9 or 10 times free cash flow. But that would be basically around $26-27 a share. So we're at close to 32 today. It did dip below 30 last week for part of the trading day. But this is one I'm going to keep an eye on. Again, I'll keep it on the watch list. I think if it gets to the mid-20s, definitely one I might take a bite on. There is some potential for TripAdvisor and others working with EU and US regulators to try to bring antitrust or monopoly charges against Google, force them to change some of their policies of how they're ordering things in search results. I don't know how likely that is, but that is a potential catalyst for the business at some point, maybe a few years in the future, because a lot of people are not pleased with how Google is using it and preferencing its own products in its search engine. So we'll see if that ever actually becomes a true catalyst, but it's definitely one of those things to keep in the back of our minds. So TripAdvisor had that big drop. Actually, interestingly enough, Expedia, which as you probably know owns like Hotels.com and Expedia and VRBO. These are all sites where you can go book travel and hotels and vacation rentals. It also had about a 20-25% drop after its earnings. Same issues, called out the same issues with Google. That stock could be worth looking at a certain point. Also not very expensive. I think when I looked at headline numbers, at least. And I guess the question is, how bad does the headwind get from Google? How much can these businesses shrink, or can they actually keep growing just at maybe a slower rate? So, I think let's look at the estimates right now for Expedia. Earnings to estimates took a big drop here, but right now, let's say call it $7 of estimates for next year. And maybe that shrinks a little bit more, $99 share price. So, today Expedia trading for less than a market average multiple. It's trading for about 14 times next year's estimates. These stocks could be interesting if they keep selling off. I think at some point, I think the pessimism may be priced in. Now, you do have to be careful that these are value traps. If Google's just going to keep hammering them. I do think they have, not all of their users come from Google organic searches. Obviously, they have their own apps. They have their own brands that people know and will go to the sites directly for occasionally. But that mix, we don't know what that mix of organic looks like exactly, but we do know that it's a headwind right now. So worth keeping that in mind. So that was the travel stuff. Zillow Group was one. I said, I think last week that I'm just having a hard time figuring out when I want to buy this thing. And unfortunately, maybe the time to buy this thing was at $30 a share or slightly under a couple weeks back. But it had an earnings report that looked relatively similar to the prior quarter, I thought. But investors seemed to get excited about it and bid this thing up on the earnings report. Again, I think even from these prices, this stock can be up 5 to 10x over the next decade if they really nail this opportunity in the home buying business that they've entered, in the home lending business. It's just too early to tell how successful they're going to be. They're still losing a little bit of money on the houses that they've been buying so far this year. So whether or not that business can be very big and very profitable, still TBD. But I think maybe there were some signs that some investors extrapolated and said, "Oh yeah, this thing is working," and so that they bid Zillow Group and Redfin up last week on both of those companies' earnings reports. The valuations today, I think, are definitely baking in lots of future success already. So it's hard to know if this train is leaving the station or if there's going to be another pullback. But yeah, these are tough ones because these stocks could easily be down 30-40%, in a given quarter or two if investors decide that the prospects for this new home buying business aren't as great as they thought. So anyway, interesting situations here. I'll keep an eye on it. Haven't been doing anything on them this week though. Let's see what else. I think that I've talked a lot already about Under Armour, but that one had a bunch of news last week. Stock was down, still pretty expensive on current earnings estimates. I'm going to wait for this thing to come in. I would love to get this thing around the $10 to $12 range. New CEO, which is good. I think I've been long talking about them needing a new CEO. So they have promoted from within though. So this old COO is now the new CEO. So it's not as exciting as it could be in terms of a CEO replacement. So again, I think the stock's also a little bit expensive on current numbers. Revenue declined year over year in their most recent quarter. Nike's growing 10% a year. So again, Under Armour just underperforming right now. Not a stock I want to own yet, but it's definitely one that I think longer term has the potential to be a turnaround story. Just not there yet. So that was one. CenturyLink, which I have a small position in, alerted that a couple weeks back. That's been a nice one. Still cheap, but good earnings report. Was up a couple bucks. I think about 10 or 15% last week on the earnings report. And that one was sporting a really nice dividend yield too. I think the dividend yield was 10 or 12%. The free cash flow yield was like 30% when we were buying it down at 11. Today it's a little more expensive, but that's still pretty cheap. I think this can be a $25, $30 stock in a year or two, but they just have to keep executing. So just going to hold that one long and strong, and good to see that results are good and stock is moving in our favor. Dropbox. So this one, as it often does with its earnings reports, it loves to sell off on a really good earnings report for whatever reason. Investors just love to hate this stock. I thought the results looked great. I didn't know what else you could have asked for in terms of results. Let me just pull up the spreadsheet I have where I keep a lot of the metrics and stuff. I know I've shown you all this before, but yeah, revenue growth accelerated. So like, here's the quarterly results. You can see revenue growth actually accelerated from the prior quarter. So grew at about 19% on a constant currency basis. Dropbox revenue grew about 20% year over year. So that's a slight acceleration back into the low 20s. It's been decelerating slowly each quarter. But again, really nice revenue growth year over year. That was driven by an increase in both paid users and average revenue per user. So all the metrics looking healthy, looking good. Their product development continues to be interesting. They developed some new product features like Dropbox Spaces and a few other things I'm forgetting off the top of my head, but definitely sounded like these were really interesting enhancements to the product. And so it'll be interesting to see how that goes going forward. But they also raised guidance. So Q4 and full year, they raised their full year guidance. If we look back at what the original full year guidance was for 2019, I believe it was like 1.62 billion to 1.64 billion in revenue, with non-GAAP operating profit margins 10.5 to 11.5. And that, of course, included some extra expenses related to HelloSign, as well as the new headquarters build out, because they were going to be basically paying for 2 office buildings at once while they transitioned to the new headquarters. So that was their original guidance. And now, as of Q3 or late Q3, the guidance for the year is 1.65 billion in revenue to 1.659 billion in revenue. Non-GAAP operating profit margins of about 12%. And I think free cash flow. Let's see, bring it up here. This is the conference call transcript. So free cash flow, excluding the headquarters build out, of about 440 to 460 million for the year. So let's call it 450 million. So really good numbers. Again, the market cap of the company today is about 8 billion. They have $1 billion of net cash on the balance sheet with no debt. So essentially we're paying, net of the cash, we're paying about 7 billion for the company today at today's prices. And they're going to do 450 million of free cash flow this year. So it's trading at about 15.5 times EV to free cash flow, which is a very cheap multiple for a company with this kind of margins, with this kind of revenue growth year over year. I mean, how many companies do you know that are growing close to 20% year over year with good, strong profitability, good free cash flow generation, trading for a below average market multiple? I mean, they're growing at 3 times the average rate of the S&P 500 company right now. The average S&P 500 company grew revenue at about 6% year over year this quarter. Dropbox is growing more than 3 times that. And so I just don't know what else people wanted to see in this quarter. I mean, great positive comments from management, great guidance. And yet here we go, right? I mean, the stock is sold off, for the last 2 or 3 trading sessions, down about 10% over the last couple of trading sessions. So I'm probably going to be buying this thing again this week if it keeps selling off. I'm kind of baffled. I know people love to hate this. Like when I was looking on Seeking Alpha, I noticed there was an article written the other day. But this guy, by the way, he writes about all these tech companies, and I don't think he actually does that much research. But so that's a caveat. But yeah, like even him, he's like this article is like not much to be excited about. It's like, well, what else do you want to see? I'm sorry that they're not unprofitable and growing a little bit faster, like all these other SaaS companies that are valued at 5-6x the valuation. But this company's executing really well. And so he says undifferentiated product, plenty of competition, but fine, that's fine. Okay. So you say there's plenty of competition. Well, they're still growing at 20% year over year. They've had competition for the last decade. Undifferentiated product, I don't really agree with, but sure, if you want to believe that they're still just file storage, then sure. They try to compare it on a valuation basis to Box, which is not only growing slower, but Box has way worse profit margins right now and is in a totally different business. They serve mainly large enterprise customers. So I think Box is kind of interesting in its own right, but like it shouldn't be compared to Dropbox, especially when this guy's using like a revenue multiple. So I'm sorry, but you just shouldn't be using a revenue multiple for a company that's profitable like Dropbox. That's just a sloppy valuation metric and one that you shouldn't use. So anyway, the people that are critical on this, I think, are kind of missing the point here on Dropbox. But that's fine. I'll continue to hold it and wait. For the market to realize that this is a much healthier company than a lot of people seem to think. So I'm totally comfortable with the current valuation, the current results. I've been very pleased with Dropbox's quarterly results, including Q3. So I don't really know what else to say. Sometimes the fundamentals get ignored, but not forever. So that's kind of how I see Dropbox. In terms of like other macro stuff, Nikki, did you have something on that?
I think that this is the clear case of just emotional sentiment that it can't stick around forever.
Yeah.
And I know I've expressed that in the room, but yeah, I agree.
Yeah, I mean this thing has a history of selling off on earnings results too. So I mean I don't know what people wanted from that report, but I'm happy. So I'll keep holding. And in terms of other stuff last week, I mentioned didn't have a ton of macro data, but we did get a nice bounce back and some strength in the ISM non-manufacturing data, which was good to see here in the U.S. And then Michigan consumer sentiment was, I think, pretty decent. This week we do have a few things on the macro data front. So we have actually some testimony from the Fed chair here in the U.S. on Wednesday and Thursday. I think a lot of people will be watching that and parsing his comments to kind of understand what's coming next in terms of interest rates. a lot of uncertainty around that next Fed move. So people are going to be watching that. The UK has a bunch of data out, like their jobless claims data on Tuesday, and then inflation data on Wednesday. We do get October inflation rate data in both the UK and the US, so that'll be watched. And then US October retail sales on Friday, that'll definitely be watched as pretty closely as we're moving here into the big holiday shopping season. And then in terms of earnings reports this week, we get a few from our watch list, like Sunrun tomorrow. That stock's been, interestingly, Sunrun and SunPower, the two bigger solar giants, have been selling off the past couple weeks. And I actually picked up some of this around $15. If it keeps going lower, I'll probably buy more. But that'll be interesting to hear their comments, because I think they're probably seeing strength given all the California blackout stuff that happened. I think that I had heard some comments that they were trying to figure out how to service all the new demand and all the calls that they were getting. So Sunrun and SunPower have been selling off, though. So that'll be on Tuesday when Sunrun reports. Some of the cannabis stocks report, some of the bigger ones report this week. Now, that's been an interesting sector. So mostly sold off today. They had a big day on Friday, though. A lot of these stocks were up on Friday. You can see the big candles here. But I think, if I'm correct on this, Kronos and Tilray report on Tuesday, and then Aurora reports on Thursday. So those are obviously some of the bigger market cap ones in the industry, and those reports will be watched pretty closely. Some of the fundamental things that have been happening to drive a lot of these stocks down generally over the past 6 or 12 months. There's been a kind of a botched rollout in Ontario. The government there has been going back and forth on how they're allowing the retail shops to open. And so that's been limiting some of the growth in the Ontario province. There's more recreational, I guess, availability happening in December in Canada. So that should help going forward. And then, of course, the vaping stuff that's been in the headlines has worried some investors in the cannabis sector, with a lot of the information coming out about the vaping illnesses being tied to, THC specific vapes. Now, it seems there were some reports, and I think this is why all the stocks were flying on Friday, which the report is that these are black market cartridges that were causing these illnesses. And so it's people that are putting in like vitamin E acetate and things that really can mess up people's lungs. And the black market cartridges had some of that stuff in it. So that was really the issue. But so, that stuff's weighing on stuff in the short term. And also debt. There's not Mad Men. This one's in kind of a financing death spiral. It's not one I've been touching. That's not one that I'm going to be investing in anyway. It's got a actually pretty interesting brand, and they're trying to be like the Apple Store of cannabis stores here in the US. But they've opened a bunch of stores aggressively in states like Florida that are just now starting to legalize medical. And so they don't have the volume they need to make a lot of these stores profitable. These stores are very expensive stores in very high traffic locations. So they're losing a lot of money. They've been burning like hundreds of millions of capital per year over the past couple of years, and they've essentially been running out of cash. And so MedMen has been super poorly managed. They paid their executives like ungodly sums of money, even though the company was just losing tons of money. They raised some money from a private equity firm through a convertible in the past couple of months. The PE firm's Gotham Green Partners, which does a lot of deals in this space. But this convertible, it prices 3 tranches that MedMen can raise capital through. The first tranche was already raised at like $3 a share, I think back in mid-spring, around May timeframe. But this month, they actually have the second tranche coming available that MedMen can draw down on. I think it's $75 or $100 million, but it's done at the volume weighted average price over the past 30 days. And so now that the stock is down here in the $1 to $2 range, the dilution, the amount of shares that it's going to take to for them to sell to Gotham Green to raise that 75 to 100 million is increasingly large, much larger than it was back at $3. So and then third tranche will have the same issue. So if the stock keeps going lower, the number of shares and the amount of dilution is going to keep rising. So the problem becomes for MedMen, if they need to raise 50 million or 100 million of incremental capital, it takes more and more shares and therefore more and more dilution to actually raise that money. So as a existing shareholder, that means you're getting massively diluted more and more as the stock price goes lower. So we call this a death spiral financing type of situation. And we've seen it with other companies like HMNY last year. Iconics was another one. Unfortunately, Nikki and I had some involvement with. Those were two that we personally experienced the death spiral financing. So when you can avoid that type of situation, it's always best to. So I think MedBin as a brand will probably be around in a few years. I just don't know if you're a stockholder today, if you're going to own any of it. So that's an issue there. And a couple of these other cannabis stocks actually have the same issue. And so those are ones you want to avoid, the ones that can't self-fund themselves for the next few years. So what's interesting though is that obviously some of these stocks like Canopy got a massive investment from Constellation Brands, ticker symbol STZ. All right, we've covered that one in some market updates before. This is actually a stock I probably need to take a look at. But they put several billion into Canopy, and they have the ability to put several billion more. So Canopy will have the cash, and theirs is not a like really death spiral dilutive type of financing. I think STZ puts money in. Canopy, they put the initial couple billion in at like $40 or $50 a share. I forget the exact price. I'd have to go look. And then the second tranche of I think $4 or $5 billion they can also put in, but it's also in the $40 or $50 per share range. So they may decline to actually do that financing, but the financing won't create unnecessary dilution unless they change the terms here. So Canopy should have the capital to stay around. Cronos is another one. Cronos I spent some time looking at last week because it's a super interesting one. The company's I think valued today around $1.5 billion. They don't actually have a lot of revenue generating assets right now. So they own a brand that they bought in the kind of CBD space, and that should produce some revenues. They do have some revenue producing lines of business and some cannabis related stuff and a little bit of retail stuff. But the biggest thing here is that they have an investment from Altria. So the Altria, the big tobacco company. Altria also owns a large stake in Juul, but Altria made a multi-billion-dollar investment in Cronos and has the ability, I believe, to invest more as well. Similar to the STZ Canopy deal, Altria has a large stake in Cronos and can increase their stake to a majority stake. So I think right now, I'm going to have to go back and double check these figures, but I believe they have like a 40%-ish stake in the company or 45, and they can go to 55. They have the option to go to a 55% stake in Cronos. Of course, they could also just at some point make an offer for the entire company, which they may or may not do. I don't know. But because of the multiple billion dollars of capital provided to Cronos, they should have the staying power to be around cash right now, but they should have plenty of capital for the next few years. They also have a really interesting CEO who I encourage you to go watch some of his interviews because he's a pretty level-headed guy and he's got a really interesting take on the industry. What I'm reading between the lines when I hear him talk is that he and his team there at Cronos are essentially going to be Altria's vehicle to roll up the cannabis industry. They haven't outright said that, but they're not as interested in, for instance, doing this race to buy cultivation acres and things like that right now. What they want to do is they want to own the valuable brands and the valuable retail in the space. And so they're kind of using their capital to acquire the brands that will be true players in the space and going after the areas of the space where they in conjunction with Altria can really have expertise. So they're going to be focusing on areas like vaping. They're going to be focused on innovations like kind of that Altria has helped driving there. And so that is, I think, a really interesting approach because right now they have a lot of capital, and as these valuations across the sector go lower, they may be one of these players that ends up being a long-term winner because they can acquire a lot of the more valuable brands, hopefully now at cheaper prices. And they also have, they have, for instance, they have an agreement with Medmin to jointly operate some of the retail locations that Medmin wants to open in Canada. Now, I don't know if that relationship is going to continue if Medmin keeps having problems, but it's interesting because, Kronos identifies this opportunity to partner with one of the leading retailers and help them expand. And so I think those are the kind of deals that it's looking to do to really become a major player, rather than, for instance, going out and competing with all the other commodity players who are buying up acres of land to grow marijuana flowers that just keep depreciating in price because of all the competition, right? So they're also, interestingly, one of the things that they're focused on that I think is interesting is they're focused on other cannabinoids. I don't even know if I said that word right, but they're focused on developing the non-THC and non-CBD cannabinoids, which, for instance, like they call out THCV, which is known for suppressing appetite as opposed to increasing appetite. So imagine obviously THC, CBD can often cause the munchies. Imagine being able to take a gummy that kind of does the opposite. So they're focused on figuring out how to extract the more relatively rare cannabinoids and then put those into products. So I think they're taking an interesting approach. I don't know if it's worth paying $1.5 billion for today, but I do think them, along with Canopy and maybe a couple others, can be longer term players in the space. So that's kind of how I was looking at that one. But there are others too. We talked a little bit in the channel today, or not today, but the other day, about IIPR, which is a REIT, Innovative Industrial Properties. Essentially what they're doing is they're going and buying properties and warehouses and then leasing it to all the operators that want to grow or want to open retail locations. And so they're kind of like the real estate landlord for all the cannabis companies. And they've been growing really rapidly. Now, this REIT is not like a cheap REIT. It only has a dividend yield of about, I think, 3% right now. And a lot of REITs trade for dividends between 5 and 10%. But that being said, they're able to grow their dividend yield pretty rapidly at about, I think they've been growing about like 30-40% year over year the last couple of years. So if you're looking 2 or 3 years out, that dividend yield actually does look pretty enticing at these prices or lower if you're valuing it on like next year's or year after's dividend yield. So yeah, this one's definitely interesting. I think especially like at lower prices, this one, I mean, if you can buy this REIT for like a 5% cap rate, then I think that becomes really interesting, because this thing should grow faster than most other REITs out there right now over the next 10 years or so. So definitely that one I would put on the interesting list as well. But yeah, so the cannabis, back to how this originally started, several of those larger cannabis companies report this week, so that could drive the sector one way or another. I'll definitely have to see how that plays out. Some other companies that report include like CBS, Dean Foods, C-Trip we get on Wednesday, Beazer Homes on Wednesday, BZH. I know some people have been in that swing trade in and out. NVIDIA is going to be a big one on Thursday. NVIDIA and Walmart both on Thursday will be pretty highly watched earnings reports. And then some other smaller companies like Wix, which has done pretty well this year. It's been kind of a choppy one, but year-to-date chart, yeah, you can see that pretty much near its yearly high. But that one had a really nice quarter the prior quarter, so it'll be interesting to see how this next quarter was for JD on Friday. So that's really it on the earnings front. Yeah, there's a cannabis conference this week and an energy conference this week at B of A. Sunrun's actually presenting at that conference, so there might be some stuff out of those conferences. Disney Plus streaming launches tomorrow. And then we've got Alibaba Singles Day, which is a big e-commerce day in China. So that may also have some effect on JD. But that's most of the stuff I've got on my list today. What are you guys looking at? Nikki, you got anything?
Just going to say, for the pot stocks this week for earnings, short-term traders, day traders, for myself, I'm going to be watching those for any momentum, but those are definitely some good ones to watch for momentum
Yeah.
for day trading. I was going to ask you, Travis, I don't know if you brought this up, the TripAdvisor special dividend. Did you see that?
Oh, I must have missed that. Did they
Is
announce
that
a special
they
dividend?
announced a special dividend? It goes ex-dividend on November 20th, and it's $3.50 a share. So I was just going to see what
you're right.
your thoughts were on that, and if that has any toy into
Oh, interesting.
new decisions, or you know what I'm
Special
saying.
cash. I totally missed that. Wow. How did I miss that? That is, yeah, I was just
Teamwork makes the dream work.
I know, usually I'm not that sloppy, but I think when they reported, I was looking at the numbers and I was like, I wasn't looking at the the actual comments or the bullet points up here. Yeah, that's interesting. Wow. Okay, so they've got a special dividend coming at $3.50 a share,
It's November
which will actually
20th.
about half of their cash. Yeah, so that'll.
I thought I saw owners. The record date was. I thought I saw the ex-dividend date was November 20th, but I'll have to double check that. But
Yeah, that may be why the stock had a quick bounce too, because that even that special dividend yield would have been, even at today's prices, is like over 10% special dividend yield. Now, the stock will drop after it goes ex-dividend. So, yeah, let's see. It declared a special cash dividend. Dividends payable on December 4th to stockholders of record November 20th.
Okay.
Yeah. So, yeah. And they're authorizing another $100 million in share repurchases.
okay, so the ex-dividend date is the day before the 19th.
Yeah.
Okay.
So, yep, you've got to own the stock on the 19th to get the dividend.
That's a hefty dividend, no?
Yeah, it's in total, it's more than half their cash, and on a per share basis, like I said, it's over 10% special dividend. We saw the only one that we've seen that big this year, it was Fiat Chrysler, also had about a 10% special dividend. So yeah, let me look at their balance sheet real quick.
I suppose if you have a long-term vision with it and think they can turn things around, then the drop after the dividend wouldn't be probably such a big deal.
Yeah. Yeah, I do expect that stock to drop about 10% on the ex-dividend date, though, because it will no longer carry the cash or the ability to get that 10% dividend. But yeah, so yeah, effectively, this is today should be thought of almost like a $28 stock. So, yeah, that's interesting though. Well, it's great too because they're not just like hoarding their cash. I would have expected them to maybe look to do some deals in the travel sector, but it looks like they feel like that's excess cash that they don't need. Interesting.
I think they're trying to reward investors for sticking it out.
Yeah, I think you're right. I think
through these
felt
tough times.
Yep, I think that's exactly right.
Mm-hmm.
Very interesting. Thanks for pointing that out.
Yeah, no worries. I've actually been looking at TripAdvisor for a while, since the beginning of the year. I've always been intrigued by it and interested in it. Yeah. So it was nice to hear your take on it today, actually. It's definitely something to keep an eye on, and if it gets to some interesting levels. I don't know. I like TripAdvisor. I like their business. I use it.
Yeah. When we traveled internationally to Asia last month, it was basically the place that we would look for restaurant reviews, because there wasn't Yelp is not really for those in the US that know Yelp. It's probably more often used for restaurant recs here in the US, but internationally TripAdvisor seems to play that role, which is interesting. We found a lot more restaurant reviews on TripAdvisor for Asian restaurants than we did for the local like Indonesian restaurants than we did on Yelp. Yelp pretty much didn't exist internationally.
Yeah, it was a lifesaver for us.
Yeah. So I can see the experience and dining segment, like I talked about, like being able to book things like experiences and also like restaurant stuff is definitely a bright spot for them, and is going to help offset the weakness in the hotel part. But I guess the big question is like, how bad does the hotel segment get? Like, they are working on the cost cuts and things like that to try to mitigate the impact. But if revenue keeps declining in that segment, how much and how fast?
Did you say that they don't break down how many of their users or visitors are coming straight to them, like direct to the app
and direct
to the website?
That's worth actually digging into. I don't know. They've probably hinted around it before, and maybe they've even
that would be very helpful
calls.
information.
Yeah. So like, I know if we go to the transcripts, if we search, I don't know if like searching.
Yeah, I tried. I couldn't find anything. I mean, I was doing it quickly, but I was struggling to find that specific information.
We might be able to I'll look at the financial filings as well to see if they've talked about it. But they've probably mentioned it at some point, or at least hinted around the number. But we'll have to find out. I could also use a more like high-powered search tool like Centeo, which has some AI stuff built into it. Might be helpful. So I'll do that after we get off the call today. But that's a great question. But, yeah, and I know. Let me just double check and make sure they didn't actually put it in this most recent result. But yeah, you can see the adjusted EBITDA contribution is almost totally driven by the hotel segment right now. Yeah. It's funny because I feel like I used to know that number of like what their direct was versus their like search driven, but I haven't seen it mentioned recently. But yeah, OCY mentioned in the cannabis sector. He mentioned in the comments playing the cannabis sector through Constellation Brands because they own the controlling stake in Canopy. I definitely think like that might be, he may be right there. That may be a cheaper way to play this trend, especially if the stock keeps selling off. It's $185 a share today. Their core liquor brand businesses are growing. Their liquor and beer brands are growing. Let me see what the estimates for earnings are. Like next year's earnings estimated at $940, expected to grow pretty nicely afterward. So yeah, today, let's say 185, you're paying about 19 and a half times next year's estimated earnings. But for a pretty steady grower and one that has the cannabis upside, doesn't seem like crazy expensive. Just double check. I know they also sold some brands, so the quarterly comparisons might not be exactly. Yeah, because like right now it looks like they're growing like low single digits, but I think excluding the brands that they sold, if you just look like on a like for like revenue basis, they're actually growing like 8 or 9%, or maybe even 10%, if I recall. Let's look it up. I think let's look up their presentation. I know their Q2 call was on October 3rd, so they won't report again for a while. They're on a different calendar schedule. They are levered. They do have net debt on the balance sheet. That is one thing to keep in mind. Lower price to earnings multiple, but pretty cash generative, profitable business. lot of their stuff is growing double digits in terms of the brands.
Everybody loves booze.
Corona and Modelo positioned pretty well for like an increasing Hispanic population. Yeah. See what they have a lot of different numbers they report here. I'm trying to figure out what the actual like organic revenue growth is. Sometimes they make it more. Oh yeah, they've got their Corona branded White Claw killer.
I saw that. Oh.
Pacifico.
Man, that is a busy document.
Yeah, there's a lot happening on this investor presentation. Yeah. Yeah, so wine growing at 8%. I think, yeah, I want to say the last time I remember looking at the actual like organic revenue growth numbers, they were like 8 or 9% for the overall business. And that doesn't include the cannabis stuff, I don't think. But yeah, we may have to scroll down a ways to get there. So I guess their goal is to grow diluted earnings per share at about 10% year over year. So, and they give some cash flow numbers that they're trying to hit as well. And they want to pay down debt and return capital to shareholders over time, which is always good to see. Yeah, here we go. And so I think we can see comparable net sales would be the one to use here because again, they've sold some brands, but it looks like 8.1 billion in fiscal 2019, 7.5 billion or so the prior year. So yeah, growing about 8% organically. Or I shouldn't say organically, but about 8% revenue growth on a like-for-like basis year over year. Not bad. If the cannabis sector too can kind of supercharge that over time and they can grow earnings per share at 10% consistently for the next 5-10 years, this stock is definitely a buy here. Yeah, I'm definitely interested. I definitely think this could be an interesting way. It's not going to be a pure play on the cannabis sector. It probably won't have the prospect for as dramatic returns one way or the other, like on the upside or downside, but might be a nice way to get some exposure to the sector without taking any like undue risk. Because a lot of the other, I really like these cannabis names, like even like Cronos, like I was talking about, and Canopy and Tilray and even IIPR to some extent are just like, yeah, there's just a lot of unknowns and uncertainty around what the future, what the total, regulated market size looks like, what the monetization is going to look like, how profitable these companies are going to be. There's still just a lot of unknowns. And some of them can easily be down 50% from here. Some of them may also be 10x's from here. It's a really hard sector to get your head around. It's probably going
to be volatile for a while.
Yep.
I mean, look at that chart. But I mean, yes, that's volatility right there. Hold on to your hats.
The Tilray chart is funny. It's sort of like Beyond Meat, right? You remember this one had that IPO at 25, went up to like 150, 160 in like a month or two, and then has been straight down.
I was thinking more HMNY, but
yeah. Oh yeah, this one was a $200+ stock at one point. That's right.
Yeah, that one went crazy.
And then if you bought at 200+, you're down 90%, 80%, 90%. Similar to Beyond Meat. Yeah, you just like you can't be agnostic to price and valuation.
This is why fundamentals matter.
Beyond Meat's doing the same thing. IPO'd, I think its IPO price, this was the first day pop, but I think its IPO price was like $20 or $30 and then went public first day, popped to 65, short squeezed in FOMO to 220, 230, and is dropping almost every day now. It's now at 76. This will probably be a $50 stock again at some point in the near future. Well, I don't really feel that bad for anyone who bought at 200.
Oh.
Fake meat taking over the world.
Yeah, wait, and especially now we've got, the big guys coming in. Gosh. I don't know, my brain isn't working, but all the competition.
Tyson Foods of the world.
Yes,
yeah.
Thank you. Yes. They're all coming out with their fake meat lookalikes, and it's going to be tough. That's going to be a tough market.
Yeah. Apollo was asking about Activision. It kind of took a little downward move there on earnings. I guess the Call of Duty stuff wasn't as robust as people wanted it to be. They had their new release of Call of Duty, and it didn't quite perform as strongly as they wanted. It was actually a pretty good launch, but I think the stock was not that cheap. It was one of the more highly valued ones in the gaming sector, which hasn't been doing that overall that well this year anyway. So like $40 billion market cap, was trading like high 20s PE. Again, I think like EA, I felt like EA all year. I've talked about EA, which is on our watch list as being one of the better values in the sector, just because you've got the core franchises at EA that just pretty much grow year after year. And then anything you have growing on top of that is sort of like free option value almost, because the core businesses really support, the multiple on the stock alone. Whereas Activision, they definitely have amazing games and properties and IP, but the gaming sector can be kind of hit driven and kind of volatile if you don't have core franchises. Now, of course, their Call of Duty franchise is almost similar to FIFA and Madden in the sense that, like, when they relaunch a new version every year or every 2 years, it has the big pop, and so that arguably justifies, a decent multiple right there on just that business. But yeah, it was trading at a premium to the sector. The sector hasn't been doing all that well this year. I guess Activision, let's look, I think in the most recent quarter, they actually shrunk. Yeah. Revenue's down 15% year over year in the most recent quarter. So, the just kind of single company, and industry issues there kind of weighing on the stock a bit, given the valuation. I think I would take a closer look at this when it gets closer to like a 20 or sub 20 multiple. Yeah, so estimates right now, they've been coming down about $2.50 a share for next year. So it's about 21 times next year's earnings. I think if it gets maybe about 10-15% cheaper, I'll have to dig in a little bit more to see kind of what's going on with the business on a more granular level. But yeah, I've always thought too, like the World of Warcraft has been a big driver for them long term, and I think at some point it becomes a melting ice cube and becomes like a terminal decline type of business. So that's one concern there too. Cool. Well, that's all I got for today. Good stuff, y'all.
Travis, it was good to be back.
Yeah, good to have you back. So hit us up in the channel, y'all. We've got Nikki now on the technical side, and both of us, anytime you have a question, fundamentals wise as well. So see y'all there.
See you guys in the room.
Later, everyone. Have a good afternoon and evening. Take care.